If I could have your attention, please. Thank you, everyone, for coming to today's workshop on the convertible debt term sheet. I want to thank everybody that could make it in person, and we're also doing a live webinar. So this is our first webinar, so the people that are online, thanks for taking the leap with us. If you have any problems hearing the presentation, please let us know in the chat box, and we'll try to resolve any technical difficulties as soon as possible. So what we're going to talk about today is a method of seed financing called the convertible debt financing, and we're going to walk through a term sheet today and start from the top and go all the way down to the bottom. And so this is really a practical, hands-on workshop, and we're going to get into the weeds and explain how this type of term sheet and this type of financing works. So some quick logistics. It's 12 o'clock, so we're getting started with the formal presentation. At about 1 o'clock, or as soon as I finish with going through the slides and the financial model, we'll have a Q&A session. And in our view, that's the most important time, because you can ask questions and we can clarify your understanding of how this works. And so if you do have questions, write them down, or if you're online, type them in the chat box. And we're going to be here all afternoon, so if you have questions, we'll do our best to answer them. So just some quick introductions. Maria and Carly did a great job of planning for this, so thanks for your help. Jamie has the challenge of running all the technology, and she contributed to the presentation. Matt, my claim to fame is we built this stand to hold the TV, and we both worked on the presentation, and we'll be answering your questions after during the Q&A session. So the first question is why convertible debt, right? Why not just sell stock and raise money with your corporation or your LLC by selling equity? So the first reason is if you have an early stage company, there's challenges as to what the value of that company is, right? So you may have a startup, you may think it's worth $2 million. But your investors who want to put money in the company may think that it's worth $500,000. And so if you have a large gap between what you believe and what they believe, you may not reach that middle ground where you can actually get a deal done. And if you were to take in money at a very, you could end up with a much smaller portion of your company than what you want to do at the present time. So with a convertible debt financing, you could avoid a lot of these valuation questions, right? And so it's debt, and there's some bells and whistles to it, which we'll explain, but it allows you to sidestep that difficult valuation question that you might face as an early stage company. Other advantages are that there's less moving parts to it. It's relatively simple in that there's maybe 8 to 10 key things that you need to focus on. I think, though, this presentation will show you that there is some complexity and some things that you need to think about. Working on the technology here. Because there's less moving parts, it's quick and easy, and hopefully you can get your money faster. There's less transaction costs, and you have more money to use for the business. So I'm going to now start from the top of the term sheet, and we're going to work our way through the bottom to the bottom. And after we do the term sheet, we're going to throw up a financial model to show how these terms actually translate financially and in terms of the ownership of the company, and show what happens when you do that next equity financing and how they tie together. So this is the typical paragraph that you see at the top of many term sheets. And this is the same that you would see in a stock financing. But some key points. This is just a summary. We sometimes run into entrepreneurs that think that if they get the term sheet signed, they're ready to take in money. This is just really an outline of the terms. This term sheet would translate into 3 or 4 or 5 documents, depending on what type of financing that you're doing. So some of the advantages of a term sheet: it frames the financing for negotiation, right? It's a summary document, so you can really see quickly what the terms are. And if you circulate it with potential investors, you may have to, it serves as that tool to get to the final financing terms. And it's also, this works. It's also a way to assess investor interest. Some other things to note, this is not, a term sheet is not binding typically. Right? It is a non-binding expression of interest. It's a discussion piece. But there are some exceptions, and we'll get into this a little bit later in the presentation. But there are certain terms like costs and expenses of doing the term sheet. Right? The investors pay for their portion, and the company pays for its portion. Governing law, confidentiality, those typically are the binding provisions. There's another one that we'll talk about as well later on in the program. You don't have a financing deal, I mentioned this, until you have a definitive convertible note purchase agreement in place. So this is the outline. You don't have a financing deal until you actually have negotiated and signed final financing documents. Okay, so now we're going to continue working our way down the term sheet. So that was just to grab your attention. So this is pretty basic, right? The name of the company, we call it Tacos and Term Sheets, Incorporated, a Delaware corporation. It introduces the investors and the type of security, which is a convertible promissory note. Just two quick things on this. One is important, and it's somewhat obvious. You need to let the investor know how much money you're raising in the financing. And that's a simple term, but it's an important term. That's part of the story that you're going to tell your investors. You need, in this case, $750,000 to advance your business from point X to point Y. And it's going to take you so much time. And when you get to point Y, you're going to be in a different stage and ready to do other things and raise money and keep the company moving forward. So it's a simple term, but something you need to think about in terms of explaining how the money will be used. There's a use of proceeds term. That's typically just handled in kind of a very general way, but sometimes investors want you to get more specific. If you're a biotech company, for example, you know, it may have a real R&D focus to it, to how you're going to use the proceeds. And what we'll show at the end with the financial model is this $750,000, when it converts to equity, there's a dilution aspect of that. So it's important to understand, before you start raising this money, what might happen to your cap table when this money converts to equity in conjunction with a later equity financing. So warrants. We've added this, even though warrants are not common in a seed financing, we've wanted to introduce it in this presentation just so that you're aware of it. Warrants, for those that don't know, it's similar to a stock option. If you have a warrant, you have the right to exercise a warrant into a certain number of shares at a specified price for a certain period of time. Okay? And so a debt investor may want a warrant because it gives them a little bit of extra juice in the investment. If the company's successful, they can exercise their warrants, get the shares, and sell the shares for more money. Again, warrants don't typically show up in a seed financing transaction. If you were to do a convertible note financing later in the company's life as a bridge financing, let's say between your Series B and your Series C financing, at that point they may ask for warrants much more than they would at the seed stage. But you do see that, and that's why we have it up here as part of the term sheet. Okay. I keep hitting this so it dances more than I want. So just some things to think about on this. So let me go through all the points. So as I mentioned, there's a formula here to calculate how many shares would be associated with the warrant. So let's say Etienne is a debt investor and he puts $100,000 in this company. The question then becomes how many shares is that related warrant exercisable into? And so there's a formula that calculates the shares. So it's the principal amount, in this case $100,000, multiplied by 1, divided by this future stock price of that future equity financing. So we'll show this in the financial model. But this is probably the most important thing to think about is, what does this formula mean? Should it be 2? Should it be 0.1? Right? So I think when we go through the model, you'll be surprised at how much dilution this formula represents. And so I just want to drive home the point that you can change these variables, and you need to understand what the consequences will be for setting the formula in this way. The term is 7 years. Typically, we see warrants anywhere from 5 to 10 years, so we pick 7. And the stock price here, the exercise price of the warrant is typically related to that future stock price. We just to show that you can, we set the exercise price at 90% of that future stock price. This is somewhat of a complicated warrant. The warrant could just be exercisable into common stock, and you could figure it out in the moment. The terms of this warrant are figured out in the next financing.
Question. Can the warrants be exercised at any time, or are there specific times?
Depends on the warrant. Note that question. We'll get to it in the Q&A session, but thank you. I just want to make sure that I know some people have a hard stop, and so I want to make sure we get through the formal program. So we're sliding down the term sheet. Okay, so closings, this is kind of just more logistical and nuts and bolts, but there's some important concepts that I want to mention. As I indicated at the beginning, this term sheet is not binding, right? And so this target date of October 14th is really, it's not binding. When you actually do the final note purchase agreement, you'll set dates in there that are more. But I think it's an important date because you want to use the term sheet to keep the momentum going in your financing. So if you have a general agreement that you're going to close in 2 weeks, it helps keep people on track to do that. Many times investors will say, I'm interested in investing, but I'm not going to put $50,000 in this company and be the lone investor. I want to make sure that there's at least some momentum in the financing and there's some initial amount of money that will advance the company. So they oftentimes will put in a closing condition. And in this case, we put in $250,000. So it's a condition for that initial closing to occur. So unless there's $250,000 at the initial closing, no money is going into this company. So that's a term that investors often will ask for in order to make sure that they're not the fool that's put in money and nobody's following behind them. The other issue that I think you need to be aware of is there's typically a date that's set as kind of the sunset period for the last closing of the financing. And here we put actually a short date of November 30th. Sometimes it'll be 3 months or 6 months. You just want to make sure that, given the read of your potential investors, that you give yourself enough time to bring in the full round. So in this case, November 30th might be not enough time, so it's just an additional practical issue to think about. So convertible debt is debt, right? And it remains debt until it converts into equity. So these are kind of classic terms that you would see in a promissory note. And so I wanted to explain those to you. So the first is maturity date, right? So you take in $100,000 from an investor, and if nothing happens, right, there's no intervening event where that debt converts into equity, the company has to pay that money back in 2 years, plus accrued interest. Right? So what's important about the maturity date is that, obviously, for the company, a longer period of time is better, right? Because it gives you more time before you have to pay it back. You want to make sure that this period of time is enough for you to use that $750,000 to advance your company and hopefully get into a position where you can do that next equity financing before you hit the maturity date. So we tend to see maturity dates of 1 to 3 years. 2 years is a common term. So on the repayment, typically it's a balloon payment. The principal and the accrued interest are due at the end of 2 years. We have seen some companies, and some of the people in the room know about some of these companies where, because of investor pressure, they've paid back the debt on a monthly basis. right? So they maybe pay back interest and even a portion of principal. We think that's a really bad idea. You have a startup, cash is king, and you want to preserve the cash and keep it in the company. So, and one thing that I did not mention is that this convertible debt is really a proxy for an equity investment. Many people that invest in convertible debt, in convertible debt financing, really want to become an equity investor in the company, right? So to already start paying back the debt before the maturity date is kind of counter to that understanding. There's an interest rate. Some people actually use compounding interest, which, if you do the math, can be really, really onerous and a lot of money. So especially for early stage seed financings, it should just be simple interest. We see interest rates from 5 to 10% typically, so we pick 7. We added this last kind of extra kicker to the interest rate. Sometimes investors will say, well, if you defaulted on the notes, the interest rate then jumps up to 2%. If we're representing company counsel, we won't mention that, right? But sometimes investors want a little bit of extra return if there's a problem. Okay, so a few additional terms that aren't as common, but they're important and they sometimes come up. So we mentioned that the convertible debt is like equity, right? So this is not a banking transaction. So the money comes in, it's typically in terms of the seniority of the debt, where it ranks relative to other creditors. It's just part of the general subordinated pool. So you might see in a later stage bridge financing with convertible debt that because there's other debt already in place, that the new investors may want to be senior to the other people that have already invested money. Typically not an issue that you see with an early stage convertible debt funding. The other issue that does come up, and it comes up a lot more in the later stage fundings, is whether there's a security interest on the debt. Right? So you as an investor will say, okay, I'll give you money, but what happens if you don't pay? Right? And so many investors will, and certainly it's like a bank, right? They would say, well, if you don't pay, I'm going to seize your assets, I'm going to sell your assets, and hopefully I'll be made whole. Part of the problem, though, of doing that with an early stage company that has valuable IP, you could inadvertently sell your company in 2 years, right? So this is not something that we would recommend to a startup company, that they would give a security interest in all the assets of the company, because you have an early stage company, you want to pay back the debt, you may not pay back the debt, and if you don't pay back the debt and there's an asset security interest, you could lose your whole company. You lose, for example, all the IP that you have in the company. So, again, these terms, we always think about them, and they don't always pop up in early stage convertible debt financings, but it's good to be aware of them, especially this asset security, which I would definitely try to stay away from. So this is just to show off my keynote presentation skills, and just to let you know that we have an important concept coming. The next term is really the crux of the convertible debt financing. So these are the conversion mechanics, and we'll spend a little bit of time on this because this really talks about how the debt converts into equity. Okay? So what happens is that the debt investors invest money in the company. And there's this idea, again, that they eventually want to be equity investors, and there's that valuation issue that the company wanted to sidestep at the beginning. So a very common term in the convertible debt financing is that under certain circumstances, the principal and the accrued interest will automatically convert into shares of stock in the next equity financing. But the investors say, well, I don't want a financing of $10 that's going to automatically convert. Right? It has to be a real financing with some meat on the bones that will cause this automatic conversion. So the trigger that will cause the automatic conversion of the notes into equity in the next financing is a capital stock financing or an equity financing of a certain size. And in this case, we picked $1,500,000. It could be $750,000, it could be $1 million, whatever is negotiated. But that's a size of subsequent or later equity financing that's large enough that warrants the automatic conversion of the outstanding convertible debt. Okay? So the next term, though, which again is another common term, is the discount on the conversion. So the equity investors say, I put money in the company with this expectation that you're going to raise a next round of equity financing in a 2-year window, but I'm taking a lot more risk. I'm putting my money in with this idea that you're going to do this financing, and hopefully you do it, but we'll see. So they say, well, if you're going to automatically convert me into this equity financing, I want a little bit of extra benefit of having put my money in first. So the term is this discount, and the debt, the convertible debt, will convert into equity at a discounted price to what the new investors are paying. So in this case, we included a discount of 15%. This discount can range anywhere, we see, from 10 to 30%. Sometimes the do-it-yourselfers get a little crazy and use even bigger numbers. But typically 15 to 25% is the range that we see, so we put in 15%. So what that means is the debt converts into that new equity security, but at a lower price, meaning that they would get more shares than if they used the full 100% of the price. Okay? But investors are smart, right? So another common term, especially that you see with experienced investors, is, so Craig, you put in $100,000, and the company's doing this next equity financing, but they have a pre-money valuation of $50 million. We'll just pick a high number. So when your $100,000 converts, even at a discount, into that next financing, it's going to be a very small slice of the ownership pie. So the convertible debt investors, and we don't always see this, but it's very common, and once the air's out of the balloon on the conversion cap, it sticks in the deal. They say, okay, we'll convert, but we're going to convert at a valuation, in this case, we put in $4.5 million. So even if the pre-money valuation in the next equity financing is really high, this conversion cap basically guarantees that the convertible debt investor will get a larger slice of the ownership pie than if they were just hanging out there with the 15% discount. So the way it works, and we'll show you this in the spreadsheet, is there's a comparison for the debt investors when they convert. What's going to give me the lower price? Is it the 15% discount? Or is it the price that I get when I take this conversion cap and I divide it by the fully diluted equity? There's a formula that we can explain maybe in Q&A. But the investors want the best of these two alternatives in terms of determining how their debt converts into that equity financing. Okay? So that was really important. So all of these are important, but that really explains how this convertible debt financing works. So the next term is prepayment. So oftentimes the company will want the ability to prepay the debt, right? They somehow are generating a lot of cash and they want to take the debt out and get it off the balance sheet. But again, which is a nice thing for the company to have, right? This right to prepay. But the investors put their money in with this idea that they were going to become equity investors and that there would be a bigger return. Instead of just getting 7% per year, they become equity investors. They own the stock. They might get a 5x return or something a lot more substantial than just 7% annual interest. So the investors will fight back. They say, well, you can prepay if I give you my written consent. Right? So they want to control whether they're going to be taken out as debt or whether they can hang in there, eventually become an equity holder and get a bigger return. In this example, I wanted to show some alternatives to that. And this is actually a real practical provision that's company favorable, is to have an alternative to that. And you don't always see either the prior written consent of the corresponding investor and this additional term. But the additional term is it allows the company to prepay the debt if the holders of a majority of the outstanding convertible debt say it's okay. So if you get holders that hold at least the majority of the outstanding debt, they say, yes, you can prepay everybody. right? Everybody agrees to that term in advance. So if you're getting pushback from the investor that they just want the prior written consent, you might be able to move to the majority rules type of concept, and that will just give the company more flexibility. We're not showing this in the term sheet, but there's a prepayment penalty that's often negotiated. So in a 2-year loan, it might be a penalty of 3% if it's prepaid in the first year, dropping down to 2% extra on the principal if it's prepaid or repaid in advance in the second year. So you can slice and dice that a lot of different ways. I didn't want to complicate the term sheet that much, but that's giving the investors a little bit extra for the company prepaying the debt. Okay. So this is another important term. It doesn't happen that often, though. And if you have an early stage company and you have a 2-year window before the maturity date, chances are it's not going to be sold in that 2-year window, but it could happen. Right? So this conversion, so before the maturity date, and if the debt's not prepaid, the company could be sold, and so then the question becomes, well, what happens to the debt? Right? So this is similar to the automatic conversion slide that we looked at. The trigger, instead of a financing of $1.5 million, here the trigger is a later acquisition. And this definition here is a fairly typical definition of a change in control or an acquisition in the future. So an acquisition occurs before the debt is repaid, and the question becomes, and the terms that need to be negotiated are, what happens? So in a very simple case, the debt could just be repaid, right? There's an acquisition, you put in $100,000, a year's passed, we owe you $107,000. Or they participate and convert into the equity security, and if that were automatic, right? So if we have an acquisition before you repay, you automatically have to participate, right? The investor is going to say, what if it's a really bad acquisition, right? It's a fire sale. I'm not going to get, I can convert into 2% of the company, but I'm only going to get, I don't know, 50 cents on the dollar for what I invested. So because the investors oftentimes look at this as an equity deal, they want to control the destiny of their investment. And so they will say, well, I get to decide. I get to decide whether I want to have my debt repaid, or if it's better for me, I want to convert it into the equity security and get a bigger return. And there's a lot of different ways that you can slice and dice this. For example, some aggressive investors will say, I just don't want my principal amount. I want 2 times my principal amount plus interest, right? Or they might say, I want to convert, but I want to convert at the lower of the 15% discount or the conversion cap price that we talked about. So there's a lot of ways to negotiate this in a way that's favorable for the investors and maybe not so favorable for the existing investors. Okay? So depending on what side of the table we're on, if we're helping to prepare this initial term sheet, we will slant this in a way that benefits the party that we're helping. So just wanted to emphasize that this is very similar to the automatic conversion term that we talked about. And again, this does happen. It doesn't happen that often just because you think 2 years is a long time, but it passes by really quickly. And so there's a good chance that you won't sell the company. So quick investor issues. The investors should have the opportunity, obviously, to do business and legal due diligence on the company. I will say for many early stage companies, it's very surprising how little due diligence some people do, but they have the right to do it. And in some ways, it's better for the company, right, to have them kick the tires so that it lessens the opportunity or their ability to come back later and claim they didn't know what was going on. In the legal documents, there are terms that control the fact that they have the opportunity to kick the tires and ask questions and look into the company. Also, just a quick statement or two on securities law issues. With these types of financings, it's best to work with accredited investors, people that have more financial resources. There are certain tests as to what constitutes an accredited investor. Someone who has, for example, a net worth of over $1 million, excluding the value of their primary residence, or someone who has earned either $200,000, at least $200,000 alone, or $300,000 with a spouse for the past 2 years, and likely going to do the same for the current year. Just from a securities law perspective and an information disclosure perspective, just working with accredited investors really facilitates the process. Another thing in terms of staying out of trouble, many of you know that there's been a change in the securities laws and how you can raise money and communicate that. So in the past couple of years, the rules have changed where you can now do what's called general solicitation or general advertising about your financing. So you can put it on the radio, the TV, social media, on your website. Problem is, if you go that route, there's other verification requirements that you need to do, even before you provide the investor documents, to make sure that they're accredited investors. So you can imagine with people on Twitter and websites, they're throwing a lot of stuff up there where they shouldn't. And if you go down that path, it can really be a problem because once you put it out there, the air's out of the balloon and you can't bring it back. So just the point to remember is it's important to talk with someone that knows how these things work, an advisor or someone, to make sure that you don't step into a problem that you can't resolve and revert. So that's a longer discussion, but I think it's a good heads up to remember. So some contractual matters, quickly. We've talked about this, that it's not final until it's final. So you need definitive documents that are negotiated and signed. So again, this is just emphasizing what was in that first paragraph. There are certain conditions to closing, and I'm putting up an example here that probably pertains more to a later stage convertible debt financing, because we have these notes that convert into equity, and we have warrants and all these things moving around. That can trigger some anti-dilution rights and some technical aspects that can affect the other securities. So sometimes a condition will be, okay, it's great, you guys are issuing convertible debt, and things will happen in the future, but we'll have all the existing stockholders waive any consequences from it. So it just keeps the capitalization cleaner. That's just one example to a condition of closing. Talk about binding terms, beginning, and we're getting close to the end of the term sheet. So, for example, costs and expenses, right? Each side covers its own expenses, right? It's just to make clear that you don't have the investors come later and say, hey, company, you said you're going to cover my $20,000 or my $5,000. Just make it very clear. So this is generally the term sheet is not binding, but there are a few exceptions. One is costs and expenses. Confidentiality, this can cut both ways, right? If it's friends and family, early stage, seed financing, the company may control the confidentiality. If it's coming from a group of investors and they don't want to be shopped, the investors may impose confidentiality on the company, or it could be mutual, right? A binding term that sometimes pop up in these that we didn't include is a no shops provision. So an investor might say, here's my term sheet, but you have to work exclusively with me for the next 30 or 60 days. And we're serious, but we don't want to give you this term sheet, and then you go across the street and cut a deal with somebody else. And so if they want a no-shop provision, that obviously has to be binding. In the governing law, we just thought we'd throw something legal out there, but if you have some binding provisions, what law is going to govern those binding provisions? Sometimes term sheets are not signed, right? The deal's moving quickly, it's an outline, and people immediately go to the financing documents, start preparing them. If you do have binding terms, though, the term sheet needs to be signed. Right? Okay. So that was the signal that we're going to go to a different document. So I want to summarize the convertible debt financing that we talked about. So if you recall, the term sheet said that there would be an initial closing on October 14th. And so we're going to say that that's the actual date of initial closing. We're going to raise And we have raised $750,000 at the initial closing. Okay, so it's all coming in at once. 7% interest rate. The warrant coverage, if you recall it, the formula that we put up was to be determined by that future financing. A conversion discount of 15% and a conversion cap of 4.5 million. So what does all that mean, right? It's amazing to me how many people enter into convertible debt financings and they say, yeah, let's go, I've got my money, I'm happy, but they have no clue what that means in terms of how that will affect their cap table in the next round. Question to be deferred.
Earlier on, you said $750,000 from the investor, but then you said the investor is going to require $250,000 to be raised. Does that mean they're actually raising $1 million?
No.
In this round?
The condition to the closing, initial closing, was there had to be at least 250. What's that?
Someone else's money?
So it's an open investment.
Right. So that means he's only going to invest $500,000.
No, they're putting in a full 750,000. We can close at the initial closing because the 750 was greater than the 250. We will cover it in the Q&A. But so the full amount of the raise is coming in at the initial closing. Okay. So the point I was making was that a lot of people do these deals, but they have no clue as to how this might affect the ownership of the company in the future. So we're going to give an example of that. So a year from today, we're going to, we looked in our crystal ball, we're going to do a Series A preferred stock financing. And in that financing, a year from today, the company's going to have a pre-money valuation of $6 million. $2 million are coming in to the company. The final pricing of this stock deal will affect the warrants, so we'll be able to figure out the warrant coverage. For simplicity, our company, Tacos and Term Sheets, has an option pool right now, and we'll just leave that alone and not adjust that. But that's also another variable that often moves in the financing. And so we want to see what the equity ownership of this company looks like and what dilution happens at that point in time. So at this point, I'm going to jump out of Keynote, and I'm going to give Jamie full control. Put up the term sheet. Put up the Excel spreadsheet. So if we could go first to the note holder tab.
Yes. Where are we going first?
We're going to go to the note holder tab, please. So I just wanted to show how this Excel model reflects the financing that we were talking about. So the note purchase agreement is October 14th, 2016. That's the closing date for all this money. If you add this up, all these numbers down below, this is $750,000. So this spreadsheet says, okay, the future date of conversion is 9/27/17. That's the date of the Series A preferred stock financing a year from today, right? That actually should be 9/29, but we'll leave it at 9/27. We don't want to change that because that'll throw the ball out of equilibrium. So it calculates the number of days, right? It then applies the interest rate, calculates interest, and gets a full conversion amount of the principal plus the interest. We drop in the 15% discount, we drop in the conversion valuation cap. If we slide over a little bit to the, there we go. So it calculates, the model calculates, okay, well, what is the price per share with the discount of 15%? And there's complicated formulas that are doing this. And what is the price per share if we do this conversion cap? So in this case, because 6 million is kind of close to 4.5, it does its magic. It compares the two prices and goes with the lower price. So this lower price is then divided into the conversion amount, and it figures out the number of shares of preferred stock, Series A preferred stock, that the debt investors get in the next round. Okay? We can go over this in the Q&A in more detail. I know I'm going quickly. Jamie, if we could go into the warrant holders tab. So we added the complication of adding warrants. So here we had a multiple of 1, right? We could change that to 0.25 or whatever we want it to be. But in Eli's case, Eli, your investor, it looks at the amount that you invested, it multiplies it by the factor, and it divides it by the stock price in the next round, it comes up with a share calculation. Okay? But I just want to show you that the model not only covers the note holder concept, but also what the warrant holders, what the debt investors, convertible debt investors get in terms of warrants. So, Jamie, if we could go to the summary page. So up at the top, before the financing, right, before the Series A preferred stock financing, there's 5 million shares of common stock outstanding. Right? Let's say the founders had the 5 million. And there was an option pool. There was options already granted covering 350,000 shares, and there's a balance in the option pool of 1.1 million shares. So that's the equity right now before we do the Series A preferred stock, and we have these convertible promissory notes hanging out there waiting to be converted. Okay? So we'll go through what the equity looks like after the financing, but just scrolling down a little bit, we see that here's the debt conversion amount. Remember, we raised $750,000, and this is occurring a little bit less than a year, so $800,000 sounds right. That is converting into this aggregate number of debt conversion shares. So the new money, and this is kind of simple financing math, the valuation of the company is $6 million. The new equity, I'm not talking about the conversion of the debt, but the new Series A investors, they're putting in $2 million. And so the post-money valuation is $8 million. So they, by the math, they want to have 25% of the company, right? Two on top of 6, or a total of 8, you get one quarter of 25%. So they need a number of shares post-financing that's equal to 25%. So our model, all of these numbers are interconnected, right? The warrants are being calculated, the shares, and so we actually have to go and toggle that number until this is like zeros, all zeros here, and so the 25% just from the dollar standpoint is the same as the number of shares that they get. Okay? So we can get into this in more detail. I'm just going high level, but Jamie, if we could go back up to the top.
That's very good.
We're going to watch Narcos. Thank you. So, moving from the pre-money that we talked about a few minutes ago to the post-money, so the 5 million slide over, right? That's the common stock. The new Series A is the 2.9 million, right? You can see that they own 25% of the company post-money after the dust settles. Well, what's interesting, the new, so that's the new, we call the new equity shares, so that's the new Series A shares. That's the new money that's coming in as part of the Series A preferred stock. The debt conversion shares, same numbers down here, is 1.4 million. Okay? So the debt investors, under the terms that we propose, they actually own almost 12% of the company. And what's really surprising, I kind of forecasted or previewed this, is that the warrants have a whopping 9% of the company. Right? So that's an example of, if you don't model this, you don't really know what's going to happen. So what you would need to adjust there is that multiplier of 1. Maybe the multiplier should be 0.1, right? Maybe they should get about 1% of the company for the warrants, right? So just want to really emphasize, if you don't go through this type of exercise or find someone that can help you do this type of exercise, you're going to be surprised. And to give the convertible debt investors roughly 20% of the company, I mean, obviously this is under some assumed terms, and we can change it and we'll get different results. But if you're not careful and you don't pay attention to what those formulas mean, you can get hit with a big surprise. The options move over, and so they represent a smaller piece of the company. Still, there's enough shares in the option pool to be meaningful. But this is the exercise that no one really does when they do a convertible debt financing. I think this is absolutely critical so that you have a general idea, and you can run different scenarios, right, under different assumptions to see how this might shake out. Okay? So, good. Go back to the keynote. So that's the presentation. So we went through the full term sheet. So we went through the term sheet. We went through the model. As I mentioned, this is the most important part of the program because it's your part of the program where you can ask questions. Just a quick thing. We're going to continue doing these workshops and probably serve more talk shows and talk about different types of term sheets. And so we do have an evaluation. We would love to get your feedback, future topics. So before you go, I just want to just mention it now. We would love to have your input. But I turn it over to all of you to see if you have any questions. We can go back to the model. We can look at certain slides. Craig.
And now, quantitative question. A friend of I know somebody who's doing a startup, and he made the mistake of going to all the qualified investors in his neighborhood, and he's taking money from that, right? This is a mistake. And there's somebody who wants to participate because he's in the neighborhood, and he'd like to exclude this person. What do the laws say about excluding investors, right? He's got the same kind of, it's just difficult to get along, right? Is there some sort of discriminatory element that you can say, I'll take this person's money, but I won't take that person's?
So the question for benefit of the webinar is that a startup is taking money from a group of investors in the neighborhood. What does that mean? There's friends?
Just neighbors, right?
Neighbors.
Right?
And there's an additional neighbor that wants in, but it's a difficult neighbor.
Difficult to speak.
Right. As far as I know, there's no right that neighbors have to invest in companies. Right? And so it really is up to the company to decide who's in and who's not. So now, if there's a little bit more backstory where there were promises and other things, but just kind of a clean fact scenario, there's no right that they have to invest. Klaus.
So talking about qualified investors, do you typically include a qualified investors questionnaire in there that you have to complete and then sign as part of the documentation for convertible note?
I'm going to hydrate and ask Matt to answer that question.
I'm going to step over here so I can talk into the microphone. So yes, you would circulate a accredited investor questionnaire, which would go through the different tests to determine, on the basis of someone's net worth or their income, whether they were an accredited investor.
But you're not obligated to substantiate any of the claims that are being made by the investor on that, tax returns or asset statements, etc.
Not in a private offering. In a public offering under the new general solicitation rules, you do have to do some additional verification steps. But typically in a private offering, which is what we're talking about here, where you're only selling to accredited investors, you're not publicizing your financing, the questionnaire should suffice.
And so those reps and warranties of the accredited investors, sometimes they're just built into the agreement that they sign, and sometimes there's a separate investor questionnaire that they sign separately. But that's the key issue, though, Klaus. If you do the general solicitation and you have to go to all these people that are hot and give you money to invest, say, well, I need to see your brokerage statement. I need to see your bank statement. I need to verify because I tweeted this out for 2 weeks straight. I need to verify that you really are a accredited investor. It throws a wrench in the process. It can be done, but it's you need to think about that in advance. That's a good question. Dave.
Back to this aggregate investment questions. So there's a goal of 750 on this unit account. 750.
Right.
But a 300K minimum. Right.
250.
So kind of talk about that. So we say we want, we know what we need as a minimum to get our initial work done and launch. And that might be the minimum. Is there any issue or guidance for why was it 750 when they really only have 250?
Okay, so the question is about the aggregate size of the financing round and this closing condition. So the aggregate investment was 750,000, and the closing condition is 250, right? 250,000. So your company needs 750,000, right? And chances are you're not going to be able to collect all of that in the initial closing. You might bring in half of it or some portion of it and have a series of closings before you reach the 750. So, but I'm putting money in. I'm going to put in $10,000, right? And I'm all excited and I write you a check, but then you don't get anybody else. So I just put $10,000 in your company. I don't know where that other 740 is coming, right? But chances are you're not going to be able to move your company forward like you explained to me. So the initial investors say, I understand you need 750, we want you to get 750, but you're not closing on my money until you get at least the bulk of it, right, together. And so that's the closing condition, that's the requirement that the investors want. Make sure that there's some momentum, there's some minimum amount before you take my check. So that should answer your question, hopefully. You don't add the raise is 750, but I as an investor don't want to be standing there, hat in hand as the only person to put in money, right?
So someone might put it into an escrow account. And until you close on the money, the company wouldn't spend that money. And so whether the investor just waited to wire the money until the company could confirm that we were going to have the closing because we'd reached the minimum, or if you set up an escrow, investors like Carlos would wire his $10,000 into escrow, and the escrow wouldn't be released to the company until that minimum was hit.
But then you can use that, too.
Yes.
So then your assumption is this investment round is not through one investor, it's going to be several.
Typically, yeah.
Typically, that's kind of San Diego, right? There's you tap into angel investors and people put in the money.
Yeah, two-part question. First one is, if you look at multiple debt in the investment, what's kind of the exit? So what percentage the company gets sold, what percentage converting equity, what percentage they get repaid, and how many are defaulting? So is it the majority actually in real life they get transformed in equity like 80%, or?
That's good. Just what happens.
Repeat the question.
So the question is just what does the data say about what typically happens with early stage convertible note financings? How many actually convert into equity? How many are paid off or convert in an acquisition? How many don't convert and hit the maturity date?
I don't know that we have that data. I can tell you how it plays out. I mean, often we have a number of companies that we're involved with that the convertible debt does convert into equity. But that doesn't guarantee that equity is going to be worth anything down the road, right? We also have seen a lot of companies that, I mentioned that the 2 years goes pretty quickly. So there's a number of cases where they reach the maturity date, but they don't have the cash. But it's a friendly investor group. And so the founders will go to those investors and say, look, can we reach an agreement where we can convert the debt, even though we're going to go outside the four corners of the contract, and we're going to reach an agreement now and convert that debt into equity. There's no guarantee that could happen, but those are friendly investor groups that they're dealing with.
My second question is related because you said one of the term is if you default there is a 2% and the following slide is like, well, the note is not secure. So what happened when you hit the 2 years? Like now it's unsecured.
Right. It's the investor's not in a great position, but that's kind of consistent with putting the money in as equity, right? If you were to buy stock at the beginning, you really wouldn't have recourse either. So, as I mentioned, sometimes the investors in the company are able to strike a deal and they convert into equity, but each company is different. Sometimes that works and sometimes it doesn't.
It's also not uncommon to extend the maturity date another 3 months or 6 months. If the company, I've seen it happen many times where the company, maybe not with a 2-year maturity, but say there's a 1-year maturity and the company's on the eve of completing the financing. In that case, typically you'd see convertible note holders agree to extend the maturity date for 3 months to enable the company to.
So that's more desirable, I think.
Well, if as Matt describes, you're really, close to getting a financing, and then you can do that if that's the way the stars are aligning in that case. Steve?
What limitations or considerations are there for convertible debt financing by entity type?
So as opposed to a corporation versus LLC type of thing? So we'll handle that generally. So the question is, are there differences or additional considerations doing a convertible debt financing for a corporation versus an LLC? We believe that for many startups, a corporation is the better way to go, although there are a lot of LLCs that get formed. As you add complexity to your cap table and your investor groups, an LLC can really become hard to manage, but it can be expensive. So you can do a convertible debt financing for either one. But the typical software, biotech, technology startup, that's typically done with a Delaware C Corp. So I would, if you're thinking about forming a company and doing a new startup and thinking about convertible debt financing, I would start analyzing it from a Delaware C Corp and only do something different if there are really good reasons to do an LLC, for example.
And in this case, where you're investing debt that's going to convert into equity, presumably a larger equity round, virtually all professional venture capital firms, just by the way their firms are set up, they can't invest in LLCs for tax reasons with having to do with their LPs. And so if you're on that track where you're expecting to go down that road, it's better to just know where you're going and get there and start as a corporation. Then you just don't have the complexity of having to convert later.
I have a follow-up question to a discount versus valuation ceiling, right? So in your example, we had said 50% discount and a ceiling of 4.5 million. The pre-money and the equity financing was 6 million, if I recall correctly. Those were the numbers.
So you're going to take 15% of 6 million.
Exactly. So if I'm doing the math, I'm setting this up, and I'm kind of saying, look, I take this $750,000, I'm anticipating to get to a value inflection point with that money, and from comparables and experience, I anticipate that to be $6 million pre. That's why I want to go raise my Series A. So I set, give the convertible debt holder a 15% discount, or 15% of 6 million, which would be 800,000, $2.85 million as a ceiling. And then if the pre-money comes in higher, it's to the benefit of the note holder to convert it to ceiling versus the discount.
That's right.
Is that a logical look at that?
Can you summarize?
Why don't you summarize it?
So the question is, thanks, Klaus.
My summary is it's right.
Great financial model with the Excel sheet like that.
So the question has to do with the conversion of the convertible debt into equity in the next round, and how you look at the conversion discount and how it relates to the conversion cap, and how to model it, right? And so in your example, you did some research and you figured that it's 6 million because that's what the comps are doing. I think if you you might want to do a best case, a middle case, kind of Goldilocks, right? And so best, middle case, worst case, and compare a few different scenarios. A technical thing, because when you do the math and you look at the 15% and the 6 million and the 4.5 million, the 15% applies to the stock price in that next round. So that's it. That's easy math. The 4.5 million cap is a complicated, and it's reflected in the formula, but I didn't get into it for the presentation. I'll get into it now. The way it typically works is the fully diluted equity capital of the company immediately before that Series A preferred stock, that number of shares. So if you remember that pre-money column, that number, so it includes the 5 million of the common stock and the options and the remainder of the pool, that's the fully diluted equity of the company immediately before. That's divided into the 4.5 million cap to determine the price. So that's the comparison point. So it's a little different than what it might appear to be, but that's how the calculations typically work. So I think if you're trying to figure out what it might look like in the future, it's anybody's best guess, right? So I would look at a few different scenarios to kind of get a range of what the potential consequences might be under different scenarios. Hopefully, I hope that answers your question. Okay.
Carlos, will you be able to get a spreadsheet, for example, or pieces other than pieces that you
We'll give you the whole spreadsheet.
Wow.
And so we'll be happy to do that. So if you want the spreadsheet or the handouts, if you could indicate that on the form, evaluation form, that would be great. But there's the spreadsheet works in many cases, but I think in your company it's relatively early stage, and so it will work fine. When you get down the road and there's other things coming in, you have to modify it. But
as like the visuals of the columns.
yeah, I'd be happy to provide that. Eli.
Yeah, one just clarifying question on what we were talking about. So in the example you gave, I think the pre-money valuation included the converted notes. Is that right? When you were talking about the new investors coming in with $2 million and wanting 25% of the company or whatever it was, the pre-money valuation included the conversion of the.
So the question is whether the pre-money valuation included the amount of the convertible debt. I don't know that it did, right? That's the negotiation that you have with the Series A, the new Series A investors. And so they may factor that in, but they do their own calculation as to what pre-money is acceptable to them. So it may not necessarily, be include dollar for dollar the amount of the convertible debt. Chances are it doesn't.
Well, when the cap is set on the conversion, that doesn't include the convertible notes. That's the pre-money valuation.
In the financing.
In
the next financing. So you'd convert, I think, yeah, to answer your question, it would not, it would be on a debt-free basis. And so, because otherwise, if you included the debt with the pre-money, then you have a problem with your pre-money plus your amount invested doesn't equal your post-money because that debt is going away with the conversion. And so more often than not, you'll see in a Series A term sheet that it's anticipated all the convertible debt is going to convert in connection with this financing. And we're valuing the company after our investment at X post-money, which would back into a pre-money of the amount of the post-money minus the amount invested.
Okay, got it. And just a real simple question. So if the debt is not secured by the assets of the company, what is it secured by?
It's just a general creditor claim. It's just part of that unsecured pool of debt. And it's jump in the cage and fight for your rights. So it's not protected. It is, though, it is higher priority than the stockholders, right? So debt gets paid off before the equity holders, the stockholders get their money. But if Silicon Valley Bank were to come in, they would be at the top of the heap. Right? They put in security agreements and UCC financing filings. And for an early stage company to go through all of that legal gymnastics to do that, it's somewhat burdensome. The other reason why, as an early stage company, you don't want to do that is if your company starts to take off and you're able to get some type of bank financing or more sophisticated debt financing, you don't want to have that convertible debt in the way. Right? They're kind of hovering around so that bank debt could easily come on top of it.
I mean, I would argue that the complexities of having a secured convertible note financing are probably greater than just doing an outright simple Series A equity financing. So it really, when you start getting into security agreements and intercreditor agreements, you're really stepping, away from the reasons why you're doing the convertible note financing in the first place, which is to get cash in quickly, relatively simply, not spending a lot of time negotiating and burning fees.
Well, from the investor perspective, the 2 years is up. the company's not giving you your money back, what happens then?
Then you pretend that you were a stockholder.
Well, yeah, and again, you know that no matter what, if the company's sold, if the company does another financing, if the company goes into bankruptcy, you're a lot more likely to get money than any stockholder because you're outside the equity stack and you're on top of it. So, yeah, unusual for be virtually unheard of for an acquirer to buy a company and not take out that debt first before any money goes to stockholders. Be very unusual for a venture capital firm to invest without taking out that debt. And if the company goes, if the company winds up, you got to pay off all your debts before you can distribute anything to stockholders. And so the investor's better off than they would be had they invested in straight equity. Peter.
Carlos, do you ever see cases where it converts, the conversion is not into common stock, but it's into Series A stock? Because a Series A stock will usually come with preferred rights for the investor.
But that's what happens here.
But
It converts into that next equity finance, that next financing security.
at that price, but it actually gets all the rights of the preferred Series A stock.
Yeah.
And so that's the standard.
Yeah.
Right. The back of the room.
Yeah, I've heard of the notes having language that at maturity, it auto converts that valuation. Is that common?
So the question is, sometimes you'll see notes that are set up to convert into a qualified financing, or if you reach maturity, they're going to automatically convert into some negotiated
$5 million value.
at some default conversion rate. I wouldn't say that's common. It's not all that uncommon either. Sometimes you see that. I mean, again, you get into a lot of times those default conversion terms get pretty draconian and they look pretty bad. It tends to be very dilutive. And that's the situation that you're trying to avoid by setting up the convertible note financing. And so from the company's perspective, I would try not to agree to that and rather negotiate it at the time. But you certainly could agree to that, and sometimes people do. Again, when you get into negotiating default conversions, and then you'll inevitably start talking about the conversion terms, you end up negotiating a lot of the things that you were trying not to have to negotiate by doing the note in the first place, and so you're again sort of stepping away from the real good reasons why you'd want to do note financing.
Just to add to that, if you can't set the valuation now, how are you going to set it 2 years from now, right? So we've seen deals where that's done, but it's finger to the wind guessing type of stuff. Yes.
Two questions. The one I asked earlier about warrants, when can they be exercised? Is there a time frame or maybe?
So in the example, the question is, when can the warrants be exercised? In the example that we gave, right, the warrants can't be exercised until that next equity financing occurs because you don't know what the shares are, and you don't know how many shares there are, you don't know what the exercise price is. All of that's determined in the next equity financing. And so typically that warrant is exercisable at that time when you get it in the next equity financing, and it would roll for 7 years after that.
Okay. And then the second question is, there's this huge landscape of way to raise capital. It starts with your friends and family, then moves to angels, the whole great. Where are these documents typically best utilized? Is it in any of the financing rounds? Or?
So the question is, when do you most often see the financing life cycle? Typically at the earlier stage, so friends and family, angel investors. We did mention, so that's where you typically see them, but you might see this type of financing go later stage where you've already taken in preferred stock rounds and you're about to do that, but you're running short on cash. So they may do a bridge financing to bridge you to that next financing.
I've heard that people say that once you start having revenue, now you can start valuing the company. That's a natural spot. Is that what you heard?
There are many companies that are valued that don't have revenue or have very little revenue. And so Certainly to have revenue gives you some extra data to make that valuation. But whether you have revenue or not, you probably should go to a professional that can help you do that valuation. But there are a lot of early stage companies or technology companies, biotech companies, for example, that don't have revenue, but their IP has value, their company has value, for example.
So as a founder of a startup, do you want to drive to be valued or not? So what is your interest as a manager?
Well, you don't want to be diluted. So if you can get a high valuation that you think is favorable, you can take some money and grow your business, that's what you want. If you don't yet have a product and you haven't gone to market and you still need to invest more, to reach a major milestone where you really have something that clearly has value, that really presents your best business case, then you want to take that money and defer value, because spend the money and then get your valuation much higher, and take in the money that you need to raise without having as much dilution. So it really depends on the market. It depends on what you can get.
So when I went to Tech Coast Angels training on how angels how they value companies, essentially at the end of the day they said, well, in San Diego we just assume every startup is worth $4 million. We start there. And then they go through some magic checklist and they either add to the $4 million or they subtract from it to get a valuation. Now, that's not a formal valuation. That's kind of more of a figure in the bank.
That's magic.
Yeah, it's black magic.
Right. So
is that illegal to ask, or is that really just an evaluation?
So the question is about valuing companies and how a group of angel investors start at $4 million value and they go up or down from there. I mean, I guess you could start at 0 and go up, right? So, or 3.
If it's a La Jolla zip code, it's 5. If it's Rancho Bernardo, it's 3.
So apparently that's a process that seems to work well for that angel investor group. I've never heard of it. There's certainly no legal issues that I'm aware of that relate to that.
That's because I'm a member of TCR That's one of several different ways that somebody can be valued. There's actually a way where I can't remember what it's called, but it's probably the most crude way it can be done. So I wouldn't take it too seriously.
But for early stage companies, it's a little bit of science, but it's a lot of art, right? It really comes down to the negotiation. And at the end of the day, how much of your company you're giving up for that amount of cash coming in.
In your examples, you talked about automatic conversions. What if the conversions are at the option of the note holder? How do you do all the math? Because you don't know who's going to convert.
Right. So that's why typically that's not the way it's done. Right? Because you could have people converting at different times. How are you going to value that conversion of that into equity? 10 different times over a year period. It's just you wait for that next deal to be done to set the value.
But even if so, I have a note, for example, where it's an option to convert at the next fundraising, but it's still an option of the investors. So they could at that time choose not to convert. I'm just thinking from a modeling perspective, would you just assume everybody converts and model it that way?
We have a lot of different scenarios under different assumptions. That obviously is very investor friendly.
Very uncommon. I mean, very uncommon to not have an automatic conversion at a negotiated, as long as you raise this amount within this period of time, we're going to auto convert, because for the reasons the company could be in the position of having to have some folks convert and other folks want to, investors don't like that. They're going to want everyone to convert. They're not going to want the company to carry the debt.
Right. So
it's very uncommon.
A future major investor coming in, so that's fine that you guys did it that way. You gave the prior investors very favorable terms, right? Because the investors in that case are really controlling their destiny, right? You may say, that's great that you did it, but if you want our $10 million, you got to get 100% of them to jump on board. Right? Yeah, but chances are they want to convert. They don't want to give new cash to just pay off with investors. And so they likely will make sure that they convert, and the new investor is still going to get their desired ownership piece of the company. So if there's significant money coming in, you're going to dictate the terms, and that gives the pre-existing investors gives them a lot of power. Susan?
If the existing stockholders or majority stockholders are actually providing the seed money ongoing, lending the corporation funds so it can continue, is it best to create notes at those times that this is convertible debt? And how would that influence this seed financing going forward?
So it's very common that people set up companies and they need to bootstrap it and they keep funding it. I would say that in many cases, they don't document it. They'll just tell their accountant and they'll make they'll note it on the balance sheet and keep track of it. But if your company is moving forward and you think that you are going to take an investment, it would be good to document it. And if I were in that position, I would want to have the ability to probably decide whether I wanted to keep it as debt or have the option to convert it into equity in the next round. And so,
what advantage either way to keep it as debt versus, and how would that influence the potential angel? Who's going to?
Well, it depends on the terms, right? I think that the next angel coming in, though, likely will not want to put in $250,000 knowing that right at day one, $50,000 is going out to the founder. Right? So there'll be some negotiation as to what to do with that debt. They may require that you convert it into equity. It really depends on the situation.
And in that case, too, where you have an existing stockholder who's continuing to fund the company, I mean, there's another reason why you'd want to defer valuation and let a third party come in, because not only is just valuation hard to come up with, but you have the added sort of insider. You've got it's an interested transaction at that point. Someone's on your board. You say, I don't want to upset this investor, but I really think we can get better terms if we go test the market. It's a good reason. There's a lot of sense in not agreeing to a valuation with your existing investor because you have not tested the market. You go out and you bring in a new investor and negotiate with that new investor to get a better valuation. It is not subject to scrutiny by other stockholders who might otherwise challenge the valuation.
Are non-accredited investors possible, such as friends and family, but they don't want to throw in $10,000 but they're not accredited?
Right. There are ways to do that. There are certain exemptions that you can rely on under the securities laws, but it's a little bit tricky. And so I think it's done often, especially if there's not kind of adult supervision on the legal side. But if it's being done that way, it's probably not being done technically, legally the right way. But there are certain exemptions where you can allow the non-accredited investors to come in. There's a new crowdfunding, equity crowdfunding is an example. We have not done one of those deals yet. It allows people of all different income levels and financial sophistication to invest in companies. I will say that there's a lot of buzz, or there was a lot of buzz about equity crowdfunding, but there's SEC filings, there's disclosure requirements, there's a lot of kind of legal and accounting infrastructure that relates to it. So you don't want to raise $50,000 and spend $30,000 on advisors, right? So I'm giving maybe an extreme example, but there are ways to do it. That's one way. There's also other ways. We could talk about that more.
The other point on that I would add is just from your perspective, from the founder's perspective, being indebted, taking money from friends and family in small amounts where they're not accredited, I would counsel people not to do that if you can help it, because you already have enough pressure to build a successful company. Having the added pressure of owing your friends and family money when knowing that they're not accredited, that $10,000 may really mean something to them. I've seen a lot of companies, have small investors that invest small amounts of money, and those investors can sometimes, be good people, but be more difficult to deal with than the, accredited investor who can write a larger check who can afford to lose the money. And so it's just administratively easier to sleep at night when you don't feel so accountable to your investors that you have to deliver quickly and they really need the money. So that's another reason why I've tried not to do that.
Dave?
Can you comment on just generally San Diego area angel investors, are they as a group convertible debt versus equity negotiation? Is that more common than investor equity?
It depends on the stage of the company. I think that a lot of angel investors do invest in convertible debt. It really depends on the angel investor, right? It depends on their kind of investment approach. It might be too early stage. But we've done a number of convertible debt deals recently where there's a lot of accredited angel investors that are investing. So again, it really depends on what works for them and what works for you. And so we gave this example where it's an early stage company. You may not get the $4 million pre-money, and so you want to defer that valuation question to later, so the convertible debt is a different.
Coincidentally, example tracks very close to it.
Great. Good. Marty?
In your spreadsheet, because I missed that, when you talk about warrants to your note, is the price tag attached or was it for asset owners?
So the question is there
warrants?
The warrants, right?
So you buy warrants or you got in your spreadsheet?
So in the example that we gave, the warrants, there's an agreement that the debt investors are going to get warrants in the future, right? And so you get a piece of paper that gives you rights to buy a certain number of shares, a specified to be determined price for a certain period of time in the future. So you don't have to pay for the warrant, but if you decide to exercise the warrant, you're going to have to pay the exercise price.
The same price what you got the note?
No,
the discount and cut.
There's a lot of ways to skin the cat on the price, but in our example,
about your spreadsheet.
In our example, the price is set to be 90% of that next stock price in that future equity financing round.
I apologize, a little bit far afield, but crowdfunding, does it involve any of these kinds of understanding? I mean, what are they getting when they get money? What is the person?
So the question is about crowdfunding and what do the crowdfunders get?
What's the legal or do they get free products? Do they get stock?
We'll just hit it kind of high level, right? Okay. So on one side, you have donation crowdfunding, we'll call it, and on the other side, what I talked about a few minutes ago is equity crowdfunding. So donation,
it's like Kickstarter.
Like Kickstarter, I have a donut shop. Actually, we have Brad has a really good donut shop in North Park. And I want to raise some money, right, under the donation. So I'll say, give me money and you give me at least $5,000, you get donuts, 2 donuts a month for the next year, right? So that's, you give me money and I give you something in return, right? And so you can imagine for movies and for, there was the Pebble Watch, right, where people, basically they gave money to the company with the expectation that they would get their watch once it went into production.
Okay. You get it like free or not?
Well, they're buying a product.
They're donating $100 in donation crowdfunding with the expectation that once they got a pool of money and they could go to production, they would get a watch. Okay? So the equity crowdfunding is actually
pre-buying something.
Exactly. Okay. On the equity crowdfunding, it could be this type of security, right? And it could be selling stock, but it has to be structured in a way that's going to be sellable in that kind of equity crowdfunding environment. But a lot of these same issues that we're talking about would apply or could apply when you do the equity crowdfunding. That's a big question. But when you do equity crowdfunding, you're selling securities. Right? It's a new change in the securities laws that kind of allow financing transactions for the masses. Okay.
And do those crowdfunding platforms manage that for a startup? The startup doesn't have to get that.
There are some crowdfunding platforms that help with that. There's complicated regulations that govern. I would just caution you, if you have an early stage company, to really understand the trade-offs and how much money you actually realistically bring in for what type of transaction costs. So I think at this point we're going to conclude. One more question from Mike. Yep.
Say the company's value of 1,500 or so in the period of the conversion, while it's still debt, before it's converted, right? Are there scenarios for the investor where the equity is factored to the value before the time of conversion?
The question is, if you have a situation where you have a lot of growth in between the time that the convertible note investment is made and the conversion event, the Series A financing, we'll call it, the valuation skyrockets. That's exactly the scenario, the reason why price caps came into being and why you now see price caps in certain investments. You know, the Ubers, the Instagram goes from, 0 to $1 billion in a year. It's those, what they call the unicorn companies, that really led investors to ask for price caps. And so it is essentially dealing with that. That's the purpose of the price cap.
So we're going to conclude it, but we're going to still be around for one-on-one questions. But I just want to respect the group, and if you need to leave, then thank you for coming. But if you have more questions, Matt and I and Jamie will. Thank you. Thanks. Thank you. Yeah, thanks for coming. Thank you. Yeah, thanks. Thanks for coming.
It is, yeah.
Sounds good. Take it easy, Ryan.
Very often, enjoy the revaluation conversation. I need to tell my attorney, I don't know how to address the evaluation, and they're supposed to get us ready for bringing in the agents. So the appropriate activity would be, say, just kind of get working with them, and then as they get further on, we bring you in and say, now we need to see.
I wouldn't say I have a I'd say, well, that's something that we're not going to do. I'm happy to discuss with you more about the company, and, if we can get some momentum in the investment discussion, then we can find out.
Okay.
That's how we're doing it.
Don't use the attorney word. I'm not an expert, I need to bring in somebody who's an expert.
But even we can get involved, and we can give you some guidance, but it's ultimately going to be what you negotiate with that.
Right.
That's really a business concept. Evaluation is really best argued, best, prepare for that conversation. We'd certainly help you prepare, but it really isn't a legal concept.
Got it. Okay, technically that's what they're supposed to do, is help us prepare.
Yeah.
Have you met Matt?
No,
Hi. Nice to meet you.
you might say, all it takes is whatever value, whatever value comes. So I would say that's fun. We have to use this number. Now, one thing.
Well, I would think it's worth having coffee with fun. I would make sure that you feel comfortable that if you decide to go further steps, we can talk about it. I don't know him well. He was involved with a venture capital firm here in San Diego a number of years ago. And I know he has, I don't know the details, but I know he's doing something up at Stanford. He's been working with them. So he has a venture capital background. He's an MD. So I think it's worth talking with him. But I don't know if it's necessarily going to be a good fit for what we need. But you should. It's probably worth exploring it. He obviously asked a question that intrigued me. So. Great. So you don't have an NDA? No. Okay. So, what is it? So I guess, hard for me to say.
This is what Mark says.
It's a compliment. I think you have your business discussion and see where you guys intersect in terms of what they are looking for and what you're doing. And just be really focused and trying to read them, right? And try to keep open the door. I mean, I think a lot of that's going to happen in that meeting. Do you have any sense of what they're looking for?
Well, I went to their R9 website. Operations, startups, efficiency planning for innovation.
Okay. I would stick though, knowing that you don't have it. Right. So I would be careful about the confidentiality piece, but I would not get into finance. I would really talk about the benefits of the product development that you're doing and what you're trying to achieve is the benefits and the opportunity. Because that's really what you're going to communicate to them. You don't need to get into all this crazy stuff. It's really about the business and the opportunity. That's what they're interested in.
Good.
That's what I would think.
Instead of it's always helpful to ask them questions about what they're looking for, what you can speak to, and that gives you a lot of information to address in the next conversation. So it's always helpful, to set up the next conversation, to have some deliverables, have something I really want to get back to on this point, so if we set up another meeting.
You may want to ask, kind of an artful way at the beginning of the conversation to try and see where they get to.
Tell us what would be most helpful. What are you looking for? And then that is the best way to. What we find when we're talking to clients is let them tell you what they want to hear.
Try to let them talk before you start. Was this helpful?
Oh yeah. Yeah, it'd be really fun.
Yeah, and if you have some questions about how it works, because they're a little complicated, Jamie and I, and Matt, come over for lunch and we'll